Hey guys, it's Julie here with TipRanks, and today we're taking a look at 3 stocks that just recently picked up new buy ratings from 5-star analysts. So let's get into it. Alright guys, welcome back. Thank you all so much for being here, and TGI Friday. Today we're taking a look at 3 stocks that in the last couple of days have either seen an upgraded or newly initiated buy rating from a top-ranked analyst. So today we're going to take a look at these companies, what it is that they do. We have a couple that are in some interesting industries, and of course how those analysts are weighing in on the stock's future potential. Now I found today's stocks using the TipRanks Daily Analyst Ratings page. Found under Tools, on this page you'll see the latest analyst ratings. I narrowed down our search to include 5-star analysts, buy ratings only, and the action to be initiated, upgraded, or assigned, and that gave us our list of stocks down below. You can check out the latest analyst ratings for yourself over on the TipRanks website or by downloading the TipRanks mobile app using the links in the description down below. Right before we jump into our 3 stocks today, this is your reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our 3 newly rated stocks. First up is a company called Service International. Service Corporation International trades under the ticker SCI. Currently priced at $72.59, their stock has climbed 13% over the past year, and in the last 3 months is up slightly at about 0.3%. Service International is North America's leading provider of funeral, cremation, and cemetery services. Since 1962, SCI has been serving families during their most difficult, personal, and challenging times, and today they are the company that more than 600,000 families turn to each year for compassionate and professional care. They operate in 44 states, 8 Canadian provinces, the District of Columbia, and Puerto Rico, serving families through more than 1,900 locations. SCI is a predominant player in a stable industry, and their size and scale provide significant competitive advantages. Plus, they are poised to benefit from the aging of America. They shared their Q1 earnings report back at the start of May, where the company did come out with both an earnings and revenue beat. For their first quarter, they reported earnings per share of 89 cents, beating estimates by 4 cents per share, and revenue of $1.05 billion, beat by $30 million. They saw their net cash provided by operating incomes come in at $220.1 million. And they also declared their most recent quarterly dividend of 30 cents per share for a yield of 1.6% payable on June 28th. Recently weighing in on the stock was one analyst from Bank of America Securities. They reiterated their buy rating based on robust recovery and visitation growth, saying that despite a dip in April, the visitation to SCI's locations saw a substantial month-over-month increase in May, reaching the highest daily average since 2017. And this rebound suggests a robust recovery capability and indicates solid underlying demand for the company's services. The SCI stock does just have 4 current analyst ratings, but comes in as a unanimous strong buy. The average price target comes in at $82.25, which would imply an upside potential of over 13% from current prices. Looking at our most recent ratings down below, we do have that 5-star analyst from Truist who increased their price target on the stock, coming in at 15% upside. Our high-end price target is 2 with an upside of 16.8%, and a low end from a 5-star analyst here at Oppenheimer at 8.5%. Our second stock recently picking up a new buy rating is Stryker. They trade under the ticker SYK, currently priced at $340.50 per share. In the past year, their stock has climbed 15.5%. It has cooled off in the last 3 months, dropping 3.2%. Stryker is a leading supplier of trauma and extremities products for surgical procedures. The medical technology company manufactures and sells products and services for hospitals, surgery centers, and surgeons to help improve patient and healthcare outcomes for bone fractures, abnormalities, and diseases. Their portfolio features a comprehensive array of intramedullary nails, external fixation, locking plates, bone substitutes, and joint solutions. Their products are in 75 countries around the world, impacting more than 150 million patients annually. And in 2023, the company saw $20.5 billion in global sales. Stryker shared their Q1 earnings report back on April 30th, where they came out with both an earnings and revenue beat. For their Q1, they reported earnings per share of $2.50, beating estimates by 14 cents per share, and revenue came in at $5.2 billion, which beat expectations by $90 million and also increased 9.7% year over year. We just recently had a 5-star analyst from Wells Fargo reiterate their buy rating on the stock. They recognized the company's growth in the orthopedic sector, saying that Stryker's hip and knee segments are projected to grow at a rate roughly 300 basis points above the market. And despite a slight downward revision in revenue growth estimates, their growth remains strong, indicating robust market performance. Launches of other medical products like the 1788 camera and Mako spine and shoulder applications further underline Stryker's innovative strength and potential for future growth, particularly beyond 2024. The Stryker stock currently has 20 analyst ratings, coming in as a strong buy with 16 buys and 4 holds. And the average price target comes in at $380, implying an upside potential of 11.7%. We can see our recently assigned buy rating here from TD Cowen has an upside of 17.5%, and there's our 5-star Wells Fargo analyst with an upside of nearly 12%. Our low-end price target is a hold rating back here in April with an upside of 3%. And our third recently rated stock is SHEL. They trade under the ticker SHEL, currently priced just above $70 per share. Their stock has climbed 21.5% over the past year, and in the last 3 months is up 5.7%. The Netherlands-based company operates refining and petrochemical complexes around the world. They are investing in both low-carbon energy and oil and gas in a disciplined way while finding sustainable and profitable ways to transition to net zero. With over 100,000 employees, they operate in over 70 countries and are the world's largest mobility retailer by number of sites. Their operations are divided into their different businesses of integrated gas and upstream, downstream, renewable and energy solutions. In their Q1 earnings report at the start of May, the company did see revenue drop year over year. However, they did initiate a big share buyback program and also had an earnings beat. They reported revenue of $78.73 billion, which did drop 22% year over year, but earnings per share of $2.40 easily beat expectations of $1.93. They saw adjusted earnings of $7.7 billion and commenced a $3.5 billion share buyback program. Recently, assigning a buy rating to the SHEL stock was an analyst from Wells Fargo. They noted the recent acquisition of Pavilion Energy by Shell, marking a significant step forward as it's expected to fortify their leadership in the LNG segment. The deal brings in a substantial increase in Shell's long-term LNG contracts and expands their supply and trading capabilities in key markets. Once again, we have a stock with just 4 analyst ratings, but all coming in with a buy. And the average price target comes in at $90.33, which would imply an upside potential of about 29% from recent prices. Here we can see that recent assigned buy rating from the 5-star analyst at Wells Fargo with an upside potential of 28%, and our high-end price target comes from Scotiabank with an upside of 35%. So that is a quick look at 3 stocks that have all picked up some new buy ratings from 5-star analysts recently. Let me know your thoughts on these companies in the comments down below. I always love hearing from you guys. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you stick to your own investment plan and do your own research and due diligence. Thank you guys so much for watching. I hope you have a great weekend, and I'll see you back here next time.